Hey everyone, welcome back to Corporate Decoder. Today we're diving into a company's financial moves that are about to get a whole lot more interesting, definitely more than just a simple loan. We've got some big news from UL Solutions Incorporated. They've essentially hit the refresh button on their borrowing arrangements. And that means big changes for how they'll fund their operations going forward. Think of it like upgrading your phone plan to get a lot more data and flexibility, all while ditching the old one. So what exactly is going on here? UL Solutions Incorporated, a company you might know for testing and certifying products to ensure they're safe and reliable, has just inked a new deal. It is called a credit agreement, and it is a pretty significant one, involving a cool $1 billion. This new facility, which they're calling the 2025 Credit Facility, is like a giant pool of money they can dip into. It is a 5-year deal, meaning they've got this access to funds for the next 5 years, and it's flexible because it's multi-currency. This means they can borrow in different types of money, not just US dollars, which is super handy for a company that likely operates globally. They also have a small portion, about $25 million, set aside specifically for letters of credit. Think of letters of credit as a guarantee, sort of like a promise to pay, which can be essential in big business deals. What's really interesting is the accordion feature. This means they can actually expand this credit facility by up to an additional $500 million. It's not automatic though, they'll need certain lenders to agree, and they can't be in any financial trouble when they want to increase it. Now, the funny part is that the main company, UL Solutions Incorporated, is guaranteeing the debt for its other international subsidiaries. This is a common practice to make the whole borrowing deal more secure for the banks providing the money. And they did not just sign the papers for fun. Right away, on the 28th of October, they drew down $291 million from this new facility. Why such a specific amount? Well, it was to pay off all the outstanding money they owed under their previous credit agreement from 2022. So they are cleaning house and consolidating their debt. Any other money they borrow from this new facility will be for general company stuff, what they call general corporate purposes. Let's talk about the cost of this money. They have a choice. They can either borrow based on a benchmark rate like SOFR, which is basically a standard way banks lend to each other, plus a margin that can be anywhere from 0.875% to 1.375%. Or for US dollar loans specifically to the main company, they can opt for a base rate. This base rate is tied to the Bank of America prime rate or other interbank rates, plus a smaller margin ranging from 0 to 0.375%. This sort of flexibility in pricing is pretty standard and allows them to choose the most favorable interest rate at any given time. This new facility matures in October of 2030, and they can pay it back early without penalties, though they might have to cover some costs for the lenders if they do. Here is a key figure to watch, a financial covenant. This means they have to keep their consolidated net leverage ratio below 3.5 to 1.0. In simple terms, this is a measure of how much debt they have compared to their earnings. They might be allowed to relax this a bit, up to 4.0 to 1.0. For a short period after buying another company that costs over $100 million, they can even offset some of their debt by using up to $250 million in unrestricted cash, which means cash that doesn't have any specific restrictions on its use. This ratio is super important because if they fail to meet it, they could be in default. The agreement also comes with the usual clauses, like making sure they provide financial reports on time, letting people know if something big happens, and restrictions on things like investments, acquisitions, and paying out dividends. And as mentioned with the new deal in place, they've officially closed out their old 2022 credit facility. All the money owed there has been paid back, and that agreement is now history. Now, what does this all mean for you, the shareholder or potential investor? Well, it directly impacts how the company can return value. Their ability to pay out cash dividends, the money they might give back to shareholders, will now be tied to them staying within the limits of that consolidated net leverage ratio we just talked about. If they're taking on more debt or their earnings drop, those dividend payments could be affected. This whole deal looks pretty standard for a company of UL Solutions Incorporated size and scope. They're essentially securing more flexible and potentially cheaper financing to manage their operations and future growth. Now let's look at the bigger picture, UL Solutions Incorporated is a company that plays a critical role in ensuring product safety and quality across countless industries. Having a strong and flexible financing structure is crucial for them to continue investing in their testing capabilities, expanding their global reach, and staying ahead of evolving industry standards. The fact that they've secured a $1 billion facility with an accordion option suggests confidence from the lenders in the company's long-term stability and growth prospects. However, we must always keep an eye on that leverage ratio. While 3.5 to 1.0 is a moderate level, any sustained increase in debt or a dip in profitability could put pressure on their ability to meet this covenant. This is a risk that any company with significant debt carries. Moreover, the reliance on third-party benchmarks like SOFR means they are exposed to fluctuations in the broader interest rate environment. Overall, this move seems like a strategic step to modernize their financing. It provides UL Solutions Incorporated with the financial muscle they need to operate, innovate, and potentially pursue growth opportunities. The key for them will be managing this debt responsibly and ensuring their operational performance keeps pace with their financial commitments. Alright, that is our breakdown of UL Solutions Incorporated's latest financial maneuver. What is your take on this credit facility and what it signals for the company's future? Drop your thoughts in the comments if this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.